Good morning and welcome to this Monday, August 31st, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it is August 31st, end of the month. Got a lot going on. Got Apple splitting today, Tesla splitting today. Typically, last day of the calendar month, first couple days of the next calendar month tend to be pretty bullish days. We do have some issues in the market. I'll be talking about that in just a bit. I'm a little bit more nervous than usual in the near term. Doesn't mean market's coming down, but just means you need to be alert. Sometimes things do happen when we start to see some sentiment indicators lining up the way we are right now. And so I wouldn't be shocked, even though it is historically the time of the month for the market to go up, I wouldn't be shocked to see us go down. We'll talk about all that in just a bit. I do want to start out though and just let you know, if you are new to Earnings Beats, you can go to earningsbeats.com and you can sign up for our free Earnings Beats Digest newsletter. Just simply type in your name, email address, hit that subscribe button, and you can join a lot of folks in our community. We send out an article 3 times a week, Mondays, Wednesdays, and Fridays, normally focusing on relative strength, earnings. This morning, actually, I provided some targets on the S&P 500, potential targets to the downside. If, and I'm going to say again, if we see some selling, I believe we are in a secular bull market. I don't like betting against a secular bull market. I certainly would not be shorting a secular bull market because a lot of times these even short-term bearish signals are ignored and the market keeps going higher. So from a long-term perspective, I certainly wouldn't be doing anything. I would stay firmly in the market and just treat any kind of a pullback as a short-term pullback that you just ride. From a short-term trading perspective, though, which is what I tend to look at the market from, I do think that there's added risk right now, being on the long side. Again, doesn't mean we're coming down. I just, you try to manage risk, and that's what I use technical analysis for, is to manage risk. It's not to be right 100% of the time. That would drive you crazy because you can't possibly get it right 100% of the time, but you can recognize warning signs. And we're going to talk about all that in just a bit. But again, if you're new, love to have you sign up for the Earnings Beats Digest. If you want to try our service, we have a 30-day no cost. It's $7, but we refund it to you within a week. So 30 days essentially for free. You can check out a little bit more about our portfolios. You can see our portfolio performance here. Aggressive portfolio, point out, having a rough quarter so far. Had a couple of stocks just haven't done well. One in particular got hit hard last week, but the other portfolios hanging in there pretty well. Model portfolio again leading the S&P. Strong AD portfolio so far the best this quarter, already 2.5 percentage points above the S&P 500. So if you want to learn more about our service, just click on that Join Today button. All right, let's move on to what happened on Friday. Well, we saw the Dow Jones up 162 points, S&P up 23, NASDAQ up 70. Mid caps bounced off their 20-day moving average. Small caps did the same thing. They both rose. So kind of, I don't want to say boring because that's what we like to see. That's the hallmark of a secular bull market advance. It gets very boring. And you're just waiting for the pullback, and you're waiting, and the market just keeps going up and going up and going up. Not by a lot. You can see that in terms of the huge moves, we're not seeing the kind of volatility that we saw back in April, May, and June. We're not seeing the huge moves to the upside, much smaller. The VIX has been coming down, even though we did have a little bit of a rise here over the last several days. For the most part, when you look long-term, I'm talking about coming down from the 80s down to the low 20s. So that's been a big positive for the market as we've been squeezing volatility out of the market. The other thing I think that's really been bullish, and I'm going to talk about this in a bit as well, is that we are seeing money rotating into some of the areas that had been beaten down so badly. We're starting to get more and more breakouts in areas of the market that were not performing well. And I don't want anyone to misinterpret me, when I talk about growth versus value. I want the value stocks to break out. I want everything to break out. Wide participation is just further confirmation of a secular bull market. So if I've got growth stocks and they're underperforming, I don't care as long as the overall market continues moving higher. That's what we want to see. We can always adjust our portfolios as we go further the next, many quarters. The key here is that we want to see the wide participation. I think we're getting that. Leadership last week on Friday came in the form of energy. That was good news. Haven't seen that much. Mostly sideways last couple of months, been trending lower throughout August, even though August was a really good month for stocks. Energy did not participate in that, but we did bounce back on Friday, up 1.8%. Materials also did well. And materials on a relative basis, you can see, doing much better than energy. Sometimes these two tend to go lockstep depending on what's going on with the dollar. But seeing a little bit of divergence here between the two. Materials continuing to move higher, energy struggling. But the two did lead on Friday. Industrials had a nice day. Staples, kind of a weird group of leadership, which is also maybe a little, it's good on the one hand because we're getting participation in a lot of areas, bad on the other, just because you want to see when the market's moving up, you want to see those more aggressive areas. Technology, industrials is fine. Technology, industrials, financials, communication services, and consumer discretionary. Those are the five that I really like to see lined up here when we're moving higher, because that's telling me the market has an appetite for risk. And when the market has an appetite for risk, we almost always go higher. So those are the groups you want to see. But this isn't bad. Again, we're rotating. We're seeing a lot of different groups lead. For the most part, those aggressive groups I talked about, especially technology and consumer discretionary and communication services, those three have been doing exceptionally well throughout the whole pandemic, to be honest. Consumer discretionary struggled at first, but they've come roaring back. All right, moving on, 10-year Treasury yield. There's really no economic reports out of any substance today. So I think the bond market will just kind of be on its own, not a lot to look at economically. But the good news is, and this was something, that we were talking about looking for, last couple of times we've seen these big spikes in the yield, which means money's rotating out of treasuries. It eventually just goes right back into treasuries. We lose any kind of movement to the upside, any kind of trend. Normally when you're trending higher, you're going to hold that rising 20 period moving average, in this case 20-day. We didn't do that in June. We didn't do it back in March. And we didn't know if we were going to do it in August. We broke out above both moving averages, but look, pulled back, held both moving averages, moved to a new high. That's something different that we haven't seen throughout this pandemic. And that's bullish. When you're getting money rotating out of the bond market, this is one of my biggest arguments for why I believe stocks are going a lot higher, is I believe we're going to get a lot of money that rotates out of the bond market. And when money rotates out of the bond market, the yield goes up. It's always inverse. Treasuries sell off, bond market sells, yields go up. Inverse relationship 100% of the time. So when the yield's moving up, it's telling you money's rotating out of bonds. And that is a good sign for the economy, because when the bond market believes the economy is strengthening, they don't want to hold bonds. They want to get out of bonds. They want to be in stocks, because if the economy is strengthening, profits are going to grow. You're going to get a lot more bang for your buck owning stocks than you are owning bonds in a strengthening economy. And I'm going to talk a little bit about transports in a little bit, and I'll show you a chart that confirms this, that Wall Street also believes that the economy is strengthening or going to strengthen, or maybe both. All right, but so far right now, I really like what's going on in 10-year Treasury yield. I think that rotation definitely will lead to higher equity prices. I shouldn't say definitely. Nothing is a definite. Nothing's a guarantee. But historically, when we see the yield rising, that generally is a pretty good sign for U.S. equities. All right, let's move on into talking technically. I thought what I would do is pull up a couple charts here. These are two charts that I like to follow that help me to confirm the potential of the sustainability of a market advance. So I always like to look at consumer discretionary versus consumer staples. And when you see it breaking out, when you see this move back to the upside and you see new highs, when you think about consumer discretionary versus consumer staples, consumer discretionary, these are companies that sell products that we want. Consumer staples, they're companies that sell products of the things we need. Big distinction. Doesn't matter what kind of market we're in, good, bad, horrible, great, you're still going to buy toothpaste. That's consumer staple. Consumer discretionary, are you going to go get that Starbucks latte? That's consumer discretionary. Those are the things we want, but we don't need them. When those types of companies, the consumer discretionary, the wants, the companies that sell the wants, when those companies are outperforming, it's generally a sign that the market is strong, the economy is strong. And so when I get a breakout like this on consumer discretionary versus consumer staples, that confirms to me that not only are we in a bull market, but it's a sustainable bull market. And that's a key takeaway. When I move on and show you this next chart, it's a little different angle, but basically the same thing. Here are the transports versus utilities. And one of the problems I had, we've been in this market where the 10-year treasury yield's been falling. And the transports versus the utilities have been doing the same thing. And there's a couple of reasons for that. I mean, when the treasury market or when the yields are going down, it's telling us, hey, the economy might be a little soft. That would be one thing. The other thing is when the yields are going down, utilities become generally more in favor because they pay good dividends, and income investors, if they can't make money in the treasury market, will turn and buy utilities. So a lot of times when the yield's going down, you'll see this ratio go down. Transports will underperform utilities. But it's generally a good sign for the economy. If you remember back from 2016, just before the election, all the way through the beginning of 2018, we had a huge run in the market. And while we did, go sideways to a little bit lower throughout some parts of that, you can see from the October 2016 to January 2018, we made a big move up in transports relative to utilities. Look at what we're seeing right here. This downtrend's been broken. When this downtrend's broken, that's generally a pretty good sign. When you come down here and look at the correlation between transports and utilities versus the S&P 500. So in other words, looking to see the relationship of transports and utilities. If the transports and utilities, if transports are outperforming utilities, typically that results in the S&P 500 going higher. When transports are underperforming utilities, that's when we have more difficulty in the stock market. So if you see this 2-year period, do you see the 2-year period here where this ratio is going down? Look at all the different difficult periods. We didn't go screaming to the downside the whole time, but we're not in a secular bear market. We're in a secular bull market. If this was going down back in 2007 to 2009, I would fully expect the S&P 500 would be going down. But instead, during a secular bull market, what we ended up seeing were 2 cyclical bear markets. So it still created problems for the market, but the market got over it quickly because we're in a secular bull market. It's a big difference. But now look at what's going on here in this I mean, we are going straight up in transports versus utilities right now. And when you look down here at the bottom, do you see that correlation almost always above 0? I mean, we've got some trips down here below 0. Don't get me wrong. It's not perfect correlation. But I think you can look at this chart and say, yeah, the majority of this is definitely in positive territory. And if you can't see that, I'll tell you, here's a little secret sometimes just to help visualize things. Let me show you how I would look at this correlation, because sometimes if you just highlight plus 0.5 and minus 0.5. So let me pull this up and just take a look. So if I just highlight these 2 zones, like really strong positive correlation to really weak inverse correlation, I want you to see how often we go into real positive correlation above plus 0.5. See all the times? Look at how many times we go negative. I think it really highlights it. Rarely compared to the positive. Rarely do we go into that inverse negative. So my whole point here is that when you see this ratio going higher, it's normally going to coincide with a very strong market. And so this is just another sign to me that says, hey, we got a sustainable secular bull market advance on our hands. So this is a long term. This is one of the things it says to me, long term, we're going higher. It doesn't say to me that tomorrow we're going to be going higher or Wednesday we're going to be going higher. I'm looking at it longer term. If I go back to that XLY, XLP, check this one out. This is even stronger correlation. I mean, I'm going back 10 years here, and this is on a daily chart. So it's telling me that over 20-day periods, this is a 20 count. So when you look at these over 20 days, there's a very strong tendency for these two to move together. And once again, over 2 years, I mean, right there, look at that big drop. That was the cyclical bear market relating to the trade war back at the end of 2018, fourth quarter 2018. Right there, the pandemic, the cyclical bear market due to the pandemic back March and April, or February, March. Both of those coincided with big drops here. But when we rallied back to the upside, I mean, look at this, moving to a new high. There you have the S&P moving to a new high. So both of these relative charts, both of these price relatives that I just showed you, consumer discretionary versus consumer staples, transports versus utilities, are both going straight up. I mean, there's a lot of people that just will not believe in this bull market. I'm telling you, based on history, that we're going higher. I can't guarantee it. Nobody can guarantee anything. I can only tell you based on my experience and based on my research and all the things that I do, when these things start to align, the market goes higher, the stock market goes higher. And if money continues to rotate out of the bond market, that could fuel a massive rally. Everyone thinks that, oh, we can't go any higher. I mean, we were already starting to melt up back in February before we had the pandemic. We got through the pandemic. Yes, it caused a lot of short-term problems and still is a healthcare problem and a big issue. But, you know, we're doing the things necessary to open back up, and the market is responding. The market's looking ahead. Market's not looking at what's happening right now or what just happened. The market's looking 6, 12 months down the road, and the market likes what it sees. Now, you can ignore that if you want. I would not. All right, I mentioned Tesla, 5-for-1 stock split today. Let's talk about that for just a second. Tesla has been straight up. I mean, you can see right here, 450. I've already got the chart adjusted here. Kind of looks weird now to see 450, but believe it or not, we were at 450 back in December. I mean, right back in here, you know, or maybe January when we first made this breakout. I think it was right around 390 was that long-term resistance area, and we broke above 400. I think that happened in January. So now anybody who owned or bought the stock at 400 has it at 400 again, except now they have 5 times as many shares. Pretty amazing run so far on Tesla. Apple also split. They split 4-for-1. So you're not seeing a misprint here, 124.81. It was 500, but now it's 124.81, 4-for-1 stock split. Makes it much more affordable. A lot of people get excited about stock splits. As a former practicing CPA, I mean, if you know anything about stock splits, there's really no impact financially. The biggest impact is that it does make the stock more affordable for more people. So folks that are trading, you know, really small accounts, when Tesla was 2,200, it made it very difficult. 500, a little bit more manageable, or 400 and change more manageable to buy a share. So until we go to fractional shares, which I think will be, you know, the norm fairly soon, until we go to that, then, you know, you look at companies like Apple and Tesla, some people need the split in order to afford to buy them. Amazon, same way. All right, so let's move on. And I want to talk a little bit about the articles I wrote this weekend, because this is the short term. I just talked about the long term. Don't misinterpret anything I'm saying. I'm bullish. I'm really bullish, and I've been bullish. I was bullish at the bottom of this pandemic back in March. People thought I was crazy, but I was bullish. I didn't give up on the long-term secular bull market thesis, and I think it's been proven to be the right thesis. So I am bullish, but as a short-term trader, I don't want to ride the market up during a bull market advance and then give it right back when I start to see warning signs. Now, do I know the market's going to pull back? No, the market could keep going up. And in fact, historically, we're in this time of the month. You know, today's the 31st. This is one of the best calendar days to be in the stock market. you've got portfolio managers, you got a lot of window shopping that takes place at the end of a month. All of a sudden they look like geniuses if they buy Apple and Tesla today. Anybody looking at their holdings at the end of the month say, wow, this person must be really bright. They've got Apple and Tesla. Well, little do they know they underperform the market by 15 percentage points because they didn't used to own it. They buy it at the end of the month to make it look, pretty it up a little bit. So we see some of that. Then you got new money coming into the market, 401ks and stuff coming in right at the beginning of the month. So first and second, all this money pours in. So this isn't just my opinion. This is a fact. I mean, I've got spreadsheets go back to 1950. And in fact, I'll give you the numbers that on the 31st of all calendar months, the annualized return on the S&P 500 is 29.19%. The first of the month is 46.45%. Second of the month is 34%, and the third is 25.49%. Now, if every day was created equal, the annualized performance for every day would be about 9% because we have average annual returns of just under 9% on the S&P since 1950. So if the first of the month is 46%, and then the 31st is 29%, and the second is 34%, and the third's 25%, we're killing those average. This is where the market makes its moves historically. Not every day, not every month, but there's a definite trend in place that you have to be aware of. You don't want to be shorting the market typically on the 28th, 29th of a calendar month. In normal months, that's not a good idea. Doesn't mean that there aren't setups sometimes where you want to short going into those periods. But historically, the odds are against you. If you know nothing else about the stock market, your odds are against you. Now, you might see some technical signs, and that might change things for you. And occasionally, you might hit it right. But I can tell you that on the first of the month, the S&P 500 has gone up 61.58% of the time. It's gone down 38.42% of the time. So you do the math. I think the odds are with you that the market is going to go up on the first of the month. The 31st of the month, you go up 57% of the time. And on the second of the month, 59%. And on the third, 57%. Now, if you look at every day since 1950, we go up 53% of the time. So there's no doubt that there is statistical relevance here where the market goes up from now till probably the middle of this week or even toward the end of this week. So that's the historical norm. But I want to bring up the flip side, because when the VIX starts to turn higher, which it just did recently, this is a daily chart, but this is a 5-day moving average of the VIX. So when you get the 5-day moving average to turn higher, obviously when you look back at the daily data that make up that 5-day moving average, it must be going up in order for the 5-day moving average to move up. But it's happening with the stock market going up. Normally what we see is when the market gets crushed or gets hit to the downside, the volatility picks up. And when the market rebounds, the volatility goes down. That's the norm. But occasionally we see the market go up and the VIX go up with it. And that's when you start to move into positive correlation with the VIX and the S&P 500. We saw it the last two times we saw it was back in May of 2019 and then in early 2020. This was back in January. But when you get that positive correlation, you can see when these both came in. Here was a big drop right afterwards. Here we went down quickly, went up one more time, and then back down. Now, I'm not saying the VIX was the predictor of a pandemic. I mean, let's use some common sense here. The VIX is just telling us the market's getting nervous. That's all it's telling us. Normally, the market isn't nervous when we're going higher. Normally, the market starts to get complacent. So it's not often that you see this. Normally, you see inverse correlation, and you can see we stay on this correlation down close to -1 most of the time. Just getting back to -0.5 is kind of a big deal. But when we start moving up to 0 or even moving into positive territory, that's when we have to be concerned. Now, let me also mention that, at the top in 2018, same thing happened. But during a major advance in the market, you can look back, and I didn't go back and look and see, okay, did we pull back 1% or 2%? But throughout 2017, we saw this happen multiple times. Here, I guess we had a little bit of a pullback. Here, yeah, we had a little bit of a pullback. Here, okay. Most of them, we had some kind of a pullback, but they weren't always this or definitely this. So don't get too crazy. But normally when market gets nervous, it doesn't handle bad news very well. And that's kind of the common sense approach to take to what this means. This just means the market's getting a little nervous while we're going higher. And so if anything were to hit, and I'll tell you one thing, I don't believe it's going to happen, but what would happen at the end of the day today if Zoom were to miss their earnings estimate? I mean, that's a company, I think they're going to blow it away. But, or maybe what if they say they see their growth slowing as things get, back to normal and more businesses go back to normal? What if they on their conference call say, we're seeing some businesses migrate back to the office? I don't know. I'm just throwing something out there. This is the leader in among the pandemic stocks, and they report after the close today. Again, I think it's going to be a big report. I'm not betting against Zoom. I'm just saying, what if? So I just think it's time to be a little bit more cautious. Longer term, stay in the market. That would be my call. I can't, give you advice. I'm not a registered investment advisor. I can't do that. But from a educational perspective, things I've learned, when the market's doing what it's doing now, you typically, from a longer term perspective, want to be part of it. So the question is just short term. And what might happen is we might see the S&P go to 3,600 and then sell off 100 points. That might be all we get, and we're right back to where we are right now. So don't misinterpret what I'm saying. I do think that there's more reason to be cautious, but I'm not looking for a bear market. I'm not looking for anything substantial. I think worst case, I'm going to guess 5 to 7% downside. That's what I would expect, worst case. And I say that because a lot of the stocks that were struggling before are now breaking out. And that's the other article that I wrote over the weekend. This was in Trading Places on Saturday. I wrote about it was yesterday morning. I wrote about 4 breakouts last week. These are not pandemic stocks that, were doing well because of social distancing and work from home. These are your stocks that were struggling and have really struggled during this pandemic. Check out MGM coming up, trying to get through. Finally, we closed, I think, just above that prior high. Volume picking up. Then we go down here to Hilton Hotels. Hotels have been horrible. Well, we got a breakout. Volume picking up. The other thing I'm noticing is, when we broke up here before on Hilton, the accumulation distribution wasn't doing anything. Now, all of a sudden, we got accumulation distribution rising. Here, accumulation distribution rising. Let's go on to Live Nation, recreational services stock. Made that slight breakout. Volume picking up last week. Look at the AD line breaking to a 52-week high. And then Starbucks, one of my favorites. I actually wrote my article yesterday from Starbucks. First time in 6 months. Starbucks that I go to finally opened inside. So went in, wrote my article from in there, just like old times. But anyway, Starbucks breaks out above that high. And accumulation distribution, incredibly strong. In fact, the last time it pulled back, notice the AD line was rising. So now the other stocks, the worst performers are being accumulated. As more and more of these stocks break out, it's going to make it much, much more difficult for the bears to get in charge, to really take charge for a long period of time. And that's why, for me, I just don't think that we're going to have a big pullback. It's probably going to be brief, and you're going to want to get back in again. If you are out, or if you're thinking about taking some profits and we do get a pullback, I would not be sitting on the sidelines for very long. I expect we're going to have a big run into earnings again in October. My only question is the big run in earnings going to be more in the strong pandemic stocks or the weak pandemic stocks? That's the big question mark, because I think the market's going up overall. I think everything's going to do fine. I just don't know which one's going to lead. That's going to be the thing to watch over the next several weeks. All right. Let's go back, and that's pretty much what I wanted to go over. You do need to, again, Zoom reports after the close today, so you got to pay attention to that. But let's go ahead into the 3 you must see and wrap this thing up. I'm going to start off with Ulta. Ulta had the big gap up last week with earnings. Couldn't make the breakout. And you can see the sellers got control, market makers in control here. But I suspect when we get back, if we get back to gap support or the rising 20-day, I think Ulta is going to turn back up again. And a breakout above 260 would be very bullish for Ulta. Watch that one closely. Next up, I want to bring up RCL. This is a cruise line, Royal Caribbean. I've mentioned, the fact that we're starting to see these AD lines. Look at the AD line back here. When we're trying to make these moves, we couldn't really break out above. Even here, we finally broke out above that prior high. But through all of this, we held. We didn't go back down to new lows. Look from here to here. Equal lows in price, rising lows in AD. And now we're not even breaking out yet. And already we're breaking to new highs on the AD line. So again, another change. These are some of the changes that are taking place, and I think very bullish changes. Last stock I want to mention is Wynn. Wynn pulling back a little bit today, but Wynn made a breakout above the earlier August high, and I think it's poised. I love this bounce off the 20-day. You see how before, when we make the move up, we come back down, we fail to hold the 20. Then you come back down below the 20, fail, get a double bottom, triple bottom, quad bottom, finally make this breakout, and now we test the 20 successfully and move to a new high. That behavior is bullish behavior. This behavior back here is either bearish or just consolidating type behavior. This, when you get the 20 rising above the 50 and you bounce off those and set a new high, that's beginning to show a rising trend. And when you're getting a rising trend out of some of the weakest stocks, man, this bull market is definitely gaining some steam to the upside. All right, that's it for today. Let's go get a quick update on the market. NASDAQ up 29, Dow and S&P down, S&P barely down slightly. Small caps, mid caps down just a little bit as well. It's going to be an interesting week for sure. We've got the history on our side in terms of end of the month, end of the month money flows, beginning of the month money flows, and so forth. That all looks good. But like I said, market's getting a little nervous, even though we're going higher. And I think tomorrow or later today, this even more than Apple and Tesla, I think Zoom, this earnings report is going to be fascinating because that they've had tremendous growth. And I can't imagine they're not beating. But the question is, what do they say anything going forward about some of these other companies maybe that, as economies are opening up, what are they seeing as far as new customers? Are those customers canceling and moving back into the office? I know many probably won't, but how is that going to impact their projections going forward? That'll be an interesting thing to listen for in their conference call. All right, that's it for me today. Everybody have a great afternoon, rest of your day, and we'll be back tomorrow over at Stock Charts for your next Trading Places Live. Have a great day, everybody. Happy trading.